Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Hello and welcome back to the Australian Finance Podcast. I'm your host, Kate Campbell, and I'm here with my wonderful co-host, Owen Rask, who is also the Chief Investment Officer here at Rask.
Kate, it is absolutely wonderful to be joining you on this overcast Melbourne morning. Today we're doing the market update, which should be a bit of fun.
Yes, so we're going to catch everyone up with the news that you need to know from all of the headlines over the last month. We're going to talk about some of our predictions for the decade ahead, have a bit of fun because it is nearly Christmas. And Owen's just going to keep us up to date with what on earth's going on, what we need to know, and mostly what we don't need to know.
Yeah, there's going to be some of that as well, for sure. I did actually ask you because regular listeners will know that we do this educational lesson in front of the market update every episode that we do these. So I did actually ask you for 3 bold predictions or just predictions.
Oh, you can say bold. That's a big
But
call.
I feel like you've come out with a bold one here, which is the second one you'll deliver. Maybe a bit of shock and awe for some of the people that are in investing circles. But we've got a few of those, and then we'll get into what's been happening in markets lately. But I'm going to catch you off guard with something, Kate, maybe off guard. Would you say, true or false, the USA's stock market, the S&P 500, has returned 30% over the past 12 months at the time of recording? True or false? It's true. Australia has returned, and just the ASX 300 or VAS, if people are familiar with that ETF, has returned 20%, true or false, over the past year.
Oh, I haven't been looking at my portfolio, but it has gone up a little bit recently, so I might say true as well.
True at the time of recording. You got it 2 out of 2. So those are really interesting dot points. So US stock market, this is just 12 months, so it's still short term, and past performance is not indicative of future performance, not that. 30% in Australia, 20%. And the key thing is both of those are not including dividends. When you think about that, most people have thought that the last 12 months has been pretty scary. Most people shoveled money into an offset account instead of invested. That would have been a bad decision because, the stock market has continued to go up. So I think there's a really strong lesson in here is that oftentimes when it's scary to invest is the time that you should. And when it's not scary is when you shouldn't. So we can talk about more of that in a minute. But
you're talking to someone here that has been shoveling money into the offset account.
Well, yeah, and most people have, because most people think that it makes sense when the number is high to put money in an offset account. And from a behavioral perspective, as you'd appreciate, that's totally fine. But from a mathematical perspective, it doesn't make sense. So, there's a lot of people that would choose to put more money in an offset account, and absolutely that makes sense, right? Because you are effectively swapping your money for a guaranteed return from saving money on your interest in your offset, or if you use a savings account or something like that, versus putting money in the share market at the time when you think things are most uncertain, right? Which is not guaranteed. So there's a massive behavioral element to that. And so it's not a mistake. It's just, from a spreadsheet perspective, it's almost always better to invest. And over the last year, that has been on full display. We can't go back in time and change that, but I think it's a perfect illustration of when people make that trade-off. It's really important to understand that over the long term, typically investors win. And this year is probably, these returns aren't normal, but they are quite common. So keep that in the back of your mind when you're trying to think about whether the market is scary, whether the market can keep going up, and those types of things. But anyway, I did ask you for some bold predictions, and we alluded to them. So Kate, can you share your bold predictions with us for the next decade?
Okay, so the first one is probably not that exciting, but I do believe that analysis paralysis is still going to be a really big present challenge for investors in 10 years' time. Mm-hmm. I think it is something that has caught us off guard time and time again in our whole lives. And I think it will continue to stay there, because even if you become really good at automating your investments, coming up with a plan, new things will pop up, new decisions will pop up, and you're still going to have to deal with that challenge of choosing something or making a decision. So I think it's a really good skill to just keep working on being mindful when you are stuck in a analysis paralysis cycle, wherever it is in your life, whether it's in investing or a career decision or a family decision, because sometimes you just have to make a decision and you don't want to get caught up in that space where you just don't make a decision for years, because that is a decision in the end. So I think that will be a challenge that we all face still in 10 years' time, even with tools that automate everything. So it's something worth keeping in mind.
That's interesting. So even with tools, you think it will still be a big problem, a big challenge that people have to contend with?
Yeah, I think the ETF providers are going to keep coming out with new ETFs. There's going to be different companies. There might be new investment options. Who knows what's going to be there in 10 years' time? Even choosing your automation tool. Instead of one or two brokers offering automated ETF investing, every broker might do it. And suddenly it's really competitive between which broker you choose to even automate with.
Yeah, we're already seeing that happening. So that's a good prediction. What about number 2? I feel this is more provocative for people.
I don't know if our listeners will find this as interesting, but listed investment companies, I do think, are probably a dying breed of investment products. I can see the numbers. Young people are using exchange-traded funds a lot more. I know Barefoot Investor did talk about LICs like AFIC and Argo, I think. But I do think exchange-traded funds, there's so much more transparency. They're easier to use. They're easy to automate. With listed investment companies, sometimes you're paying more or paying less than what you're getting inside. So I just don't think it's as great a product as exchange-traded funds. And I mean, maybe there'll still be a few around, but they've probably got a lot of marketing to do to stick around in another 10 years.
Yeah, so for folks that aren't familiar, so there's ETFs, which most of us are familiar with. I think based on some data around us, I would say that 90% of our community invests in ETFs, maybe more. Some of the surveys suggest it's about 75% for the Rascals. But the other kind of the thing that was around before ETFs is LICs, L-I-C, listed investment companies. And they're the big ones are AFIC, Argo, Whitefield, Wilson Asset Management, or WAM. These are the names of probably the biggest ones. And they haven't been as common. So if you look at the total amount of money invested in ETFs versus listed investment companies, ETFs have just blown straight past LICs. And we've talked about the virtues of both over time, but I think for most people, they're most familiar now with ETFs, the newer investors, and they're getting used to the differences, like you said, transparency, but also getting your tax statement at the end of the year from an ETF. It's quite different to owning a LIC, which is more like a company. So you use like ShareSite on a Vexa or something. Interesting. So that's quite controversial for people that are in the investing circles. The mighty Kate Campbell coming out swinging.
Well, I have to come up with something. I mean, what's the prediction? Yeah, and I have been seeing some LICs closing down or turning into unlisted managed funds because they've been at a discount for a long time. So people have really said, that's enough. We want something different. So there you go, a prediction.
Yeah, I like it. I know, I like it. You're alluding to something that I should probably clarify for people. So in an ETF, when you buy and sell it, you're basically getting 1 for 1. So you're getting the money that you put in is the same amount of units that you get back. So you kind of get it 1 for 1. It's very, very close to that. Whereas with a LIC, the big problem that they've always had is because they're companies, I won't go into it today, is that you might not always be getting 1 for 1. Sometimes the share price can move above or below the value of what's inside it. So when you trade it, you're not always getting 1 for 1. So it can be good or it can be bad. And a lot of investors don't like that uncertainty.
No, because it can stay below for a very long time.
Yeah, it can. Number 3 of your predictions, Kate, for the next decade.
Right. Now, this is probably much easier to back up, but I do believe that ETFs and automated investing will be a staple in everyone's investing toolkit. I believe that there are going to be more brokers offering automated investing. So you can set up, this is my ETF, my share, my managed fund strategy, and every month $500 is going to go in and this is how it's going to be allocated. I believe that that's going to become more common. So hopefully it'll be more and more options coming up, which can hit that analysis paralysis point. But hopefully automation will become even better because more providers will offer it and that will make it more competitive. I believe that ETF providers will probably start offering more advertising and education because the ETFs market's going to be quite saturated, so they're going to have to do more to win. And I also think there's going to be more and more thematic ETFs offered. So maybe an ETF doing whatever the next version of AI is, because once everyone has their staple ASX 200, S&P 500 ETFs, if you want to keep bringing more and more funds in, more investors in, you've got to keep launching flashy ETFs. So I think there'll be even more of those. I've seen how many different ETFs there are in the US and how many different niches you can create an ETF for. So I think that'll keep happening over here.
You know who's done our education really well, not just in ETFs, but more broadly, Kate, is you. You've done that really well over the past, 6 years, not just with me and with Rask, but also before that with How to Money and things like this. So you were very early on this trend of trying to bring education using tools like websites, podcasts, social media, one of the earliest in that regard. So kudos to you. And I think, we're kind of talking our own book here a bit, but I feel like that that is very, very apt. Now, I'm going to share my 3 predictions, and I'll be a little bit quicker, but I just need to look up something because we did our notes for this last week, and I want to make sure that I've got the data, as they would say, for this particular aspect. And so we put our notes down for this episode about a week ago. Then I managed to short this circuit in our office, and then we had to get the electrician in, and we couldn't record the episode. So since then, my silly prediction was going to be, I had one silly one amongst 2 decent ones. My silly prediction was going to be, and I'm looking at it right now, was that Bitcoin would reach $100,000. Now it's basically there already. So just a couple days ago, it reached $99,220. So if we put that in Aussie dollar terms, let's just quickly flick this over. I'm just looking at my numbers now. It's already $144,000, which is absolutely stupendous. So over the last 5 years, it's up 1,100% in Aussie dollar terms. So my prediction was going to be $1 million. So it's already hit 100,000. So I think maybe Bitcoin could hit $1 million in the next decade, which is kind of crazy. But who knows? This is not me saying I'm not invested in it in any way, really. But I thought that was quite interesting. My number 1 is kind of like your number 3 in a way, which is that I think 90% of people's investments will be like core, low cost, not necessarily just low cost, but just like diversified, sensible investments. Because I believe that over the next 1 to 2 years, people will wake up and realize that low fees aren't everything. It's been good for people to realize that fees are important, but I think as people become more literate, they realize that the lowest cost thing isn't always the good thing, like lowest cost broker, lowest cost ETF, lowest cost financial advice, lowest
cost vacuum. Would not recommend.
It just doesn't make sense. As you mature as a person, I think you get a better appreciation for quality. And as you mature as an investor, you also tend to get a little bit less price sensitive, and you tend to be a bit more realistic in getting value for money. I liken it to like Aldi versus like Costco. The Aldi has always been like cheap, which is great. But Costco has never said that they're cheap. They've always said we're good value, which is a very different proposition. You feel similar, but you walk away from Costco with a kind of half full wallet, and you get a lot more products for the price that you pay. So that's what I think the transition will be. But I think most people, and we already see this in like Pearl's data, is that most people will be investing in like core portfolios, not so much having majority in stocks or LICs, or that you were referring to before, or even managed funds. The majority of money will be rules-based, so index funds, sector funds like healthcare ETFs, what we call factor funds, which are like quality ETFs, like investing in quality companies, like that type of a thing, I think will be majority of people's money. And I think like you and Tash Invest have often said that if you treat your money like a subscription, you would just, if you set it up that way, it would just run in the background. Like you don't check what Netflix is doing behind the scenes every day. You just assume that when you turn your TV on, Netflix is going to be able to offer you some sort of video or movie or something. And that will be the same for what most people do with their investing, I think. My last one, because I already had the ridiculous Bitcoin $1 million one. The other one is that I think the Australian share market will make a comeback in the next decade and may even this might be somewhat controversial, may even get to a point where it could outperform the USA again. So over the last 123 years until the end of 2023, the Australian share market is the number one in the world. And I think it's only people are like they're so surprised when they hear
But
that.
what about Apple?
Yeah, what about Netflix? What about, Amazon? Well, Australia's been the best. So that's including both dividends and growth. But a lot of people forget that. And I think that, the US is still a force to be reckoned with in terms of its stock market and business culture. But there's a chance Australia is still one of the best stock markets over the next 10, 20, 30, 40, 50 years, in my opinion. We've got great companies. We've got a good, stable democracy. We've got good culture. We're probably going to spend more on defense over the next 30 years, which we need to do, in my opinion. And so all of those things combined would mean that that should foster. We've got great immigration, the millionaire migration, which is Australia is one of the biggest sources of millionaires in the world because they see Australia as a beautiful country and land of opportunity. And as long as we maintain that policy and that environment for people to come, like multiculturalism, we will excel. Like if you go back 30 years ago, the US was very pro-immigration. And you look at all the big tech CEOs, all the founders, Elon Musk, South African, right? Satya Nadella, Indian, like Sundar Pichai from Google. Like you just go through the list. You see that in action and think that could potentially be what Australia exposes itself to if we can maintain that. So I'm pretty bullish on Australia. And I think we might even have the best performing stock market over the next 10 or 20 years. Yeah, there's a lot of countries in the world, but I don't like rule Australia out is what I mean to say. So that's my kind of bold prediction. I don't know if it's going to happen, but I think it could. It could. It's a possibility. So I'm excited by that prospect, Kate.
Oh, well, we'll see where we're at in 2034.
We can set a reminder with Siri and say, hey, in 2034, get Kate on the podcast and check back in on this because I think, it'll be quite interesting. It'll be very interesting.
Oh, I can't imagine myself in 10 years' time. Wow.
What will you be like? Maybe you'll be fully automated by then. There'll be no partial automations, but we can joke. But okay, we do have to get to this monthly update.
Yes. Now you've got to tell us what on earth has been going on over the last month, Owen, and what we need to know as investors.
Yeah, so we just try and use these episodes to cut through a bit of the noise. And if you hear me clicking, it's just because I've just got a few different notes and tabs and things open so I get some more accurate data. Just for people's clarity, some of the data that we throw at you is going to be a bit mixed. Like some of it's going to be like monthly, some of it's going to be for the month of October, some of it's going to be the last 30 days, year to date. I'll try and clarify things as we go through. I think the big thing that's happened since we last did one of these, Kate, is obviously we had the US election. And so Donald Trump beat Kamala Harris as expected, to be honest. And so what that did for businesses, what it did for governments, what it did for currencies, what it did for stock markets, literally every type of financial thing is in the lead up, you get a lot of uncertainty because when the kind of the executive, the chief executive of the world's most powerful country is up for grabs, there are a lot of things said and done which kind of shake opinions and businesses don't know how to react, countries don't know how to react. And so you end up in this situation where 1 minute the stock market's up, 1 minute it's down, it's quite volatile. And that's just the stock market, of course. But you've probably heard, Kate, over the last few months, like people are saying, Donald Trump, just dictator, blah, 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 and just stuff. I'm sure you've heard people say stuff like that. Yeah. And things like, that it's so uncertain. What if he gets in? What if she gets in? Like just a lot of craziness around people's opinions and buying into the hysteria of the media, to be honest, on both sides. When, to be honest, it has never really been that way. And I think you look at probably the best example is like with the establishment of certain government bodies in the US with, we'll use Elon Musk as an example of being more involved in government decisions. And obviously he's got a conflict of interest being Tesla and SpaceX and these types of things. But the US government also has a conflict of interest because they want those two things to dominate the world. Because if they don't, then Tesla will lose to China's BYD, and SpaceX will lose to another countries like India's or China's space race ambitions. So I think the what I'm trying to say is that the government of today is kind of pro-business and pro-innovation, which has consequences for investors because it would be supportive of the stock market. And we can see that in the data already, like since the election was won by the Trump campaign. You've seen things like the NASDAQ jump, the SP 500 jump. You've seen the Hang Seng in China fall, even though it's quite up. You've seen things like Bitcoin rise because there's some sort of belief that Trump is pro that, Gold was rallying this year because gold is typically a beacon for uncertainty. So you see gold serves two purposes in people's portfolios. One is they buy it when they're most fearful because they think, well, this is like an old school thing. It's crazy how this has gone throughout hundreds of years of the financial zeitgeist, Kate. But the reason people buy gold is because they think, well, if the government falls, at least I'll have gold. But the reality is most people buying gold these days are buying it through an ETF. It's not like if you buy the GOLD ETF from GlobalX, you're going to go to London, pick up your gold in like a civil war or something. It's kind of crazy to think that people still think that way. But that's why people tend to go to it. In addition, obviously it's used now by investors as some sort of inflation hedge. So people buy it when they're fearful that inflation could come back. I think there are better ways to do it, but that's okay. So gold has been on an absolute tear this year. Bitcoin is up over 36% now. The Australian dollar has been volatile. The Hang Seng, which is a representation of the Chinese stock market, is up mid-teens % this year, but more recently has fallen. Something that we like to do is quote the ING term deposit so people can understand. There's no affiliation here with that, but just so people can understand where you can get a 1-year term deposit for about 4.95. So it's still pretty consistent with last month, but maybe down slightly from 3 months ago. The NASDAQ has done pretty well over the last little while, and that's based on what I just said. A lot of the companies in the NASDAQ 100 have really powered ahead from this pro-innovation cycle. So if Trump's in, he's most likely going to try and help spread Americanism throughout the world. So that includes supporting companies like Apple, Google, Facebook, like all of these companies that are American companies that can take the American ethos and way of life.
Have they not spread all around the world already? Like if I just look in my office, all the different products that are probably American.
Well, yeah, that's fair, right? They are. And I think that's, I think there's some really interesting things that could come out of that over the next 2 years for Australia in particular. But you see that, right? There's Teslas on the road everywhere nowadays. So you see those things, but you also see Chinese cars on the road everywhere. Chinese made in China is also probably in your office there at home. So there's a lot.
Got way too much junk. I've got to do a tidy up.
Yeah, but even like the books behind you on your shelf, the books behind me on my shelf, they probably printed in China. So like this is just the world that we live in these days. And, the fortunate thing for us is that there's a very good relationship between Australia and China and Australia and the US. So from an investment perspective, it's definitely easier to invest and safer to invest in the USA. But that's quite interesting from an investor's perspective. It's like, well, we can invest in Apple, we can invest in Google, we can invest in those types of companies. But how many of us invest in Unilever, or how many of us invest in Standard Chartered or one of the big UK banks? No one really. And so, I know one person, and he happens to be a UK citizen, so it makes sense. But he lives here in Australia now. But my point is that that relationship has been very good, and it's really important that investors are mindful of that as we go through the next decade. But all in all, the last year has been extremely positive for investors, extremely positive, way more positive than people would have imagined, I think.
And it's always interesting there because the headlines you get and the reality for a lot of people is they're having a challenging time right now. The market can be doing something completely different to the on-the-ground experience people are having.
Yeah, so really important that you're alluding to something there, which is a really important distinction that people need to make, is that the stock market is not the economy. And Buffett has talked about this over decades many, many times and said that the stock market is not the economy. The economy is not the stock market. And there's many different reasons for this. But one of the reasons might be, the most obvious reason, is that the stock market tends to be forward-looking. So when you buy a stock, you don't typically buy a stock for 1 times the yearly profit. Like you don't go onto the stock market and pay 1 times the profit of BHP. You tend to pay like 10 times, right? And then in the really good times, you tend to pay 15 times the yearly profit. Under the surface, the profit amount can change, but the sentiment, the willingness of other investors to pay more or less can drive returns in the short term. And the key understanding here is that in the dark times of our economy is when people expect things to get better. Because like when it's bad, we expect things will get better from here. So what do? You buy shares because you expect things to get better. Whereas in the economy, it can still be very bad, but the expectation is that it will get better. And that's what's happened over the past year in virtually every single type of investment. Like it's not normal that every single thing goes up. You could say that bonds have been kind of flat year over year, but that's what they kind of are supposed to do. But literally everything's been good. Property's gone up. Cash gone up. US shares gone up. Chinese shares gone up. European shares gone up. Australian shares gone up. Like literally everything has gone up. At the same time, people are worried about their job. They're worried about the cost of living. It's been really, really interesting in that regard. Another one is like gold has gone up, over 30%. Like just looking at the NUG ETF from Van Eck this year, at the same time as everything else has gone up. That again is not normal. So it's been a really interesting year. The past month has been pretty positive, I think it's fair to say, across every camp. Probably the only thing that's gone backwards is bonds here in Australia, or our bonds, I should say. But there's still a lot of like good reasons to own bonds right now, and they're paying really good income compared to 2 or 3 years ago. So all in all, Kate, super positive. I think
so. You're not changing anything as an investor? You're still...
No, we haven't changed anything for our Rask Invest service. And I don't see any reason to... I think like the challenge for investors, if you invest the way we do, is even though you have a core portfolio, like a set and forget portfolio, a lot of people don't like to see big drawdowns, like big falls. And so one of the ways you can do that is not through like buying or selling the whole portfolio, but just tweaking it through time. And so one of the things that we'll be looking at is like, well, if interest rates keep falling, and I'll comment on that in a second, once they're at their lowest point, whenever that might be, in 6, 12, 24 months, who knows how long it's going to take for interest rates to fall again. But once they're at their lowest point, that will be too late to react. You need to react before you get to that point. And that's like people that want to invest right now in the stock market. Yeah, great idea. But it would have been better a year ago. When we were saying you should still keep investing, and a lot of people didn't. So what we are trying to think about is, well, what are we going to be doing in early next year? What are we going to be doing in mid next year? Trying to cast our minds forward to that. And so some of the things that we haven't done, but we might look at doing is changing our Australian ETF holding. So we hold a lot of VAS as an ETF. If you hold A200 from BetaShares, disclosure sponsor of the show, if you hold STW, if you hold IOZ, but these are all the same. They're all fine. Doesn't matter which one you choose. But if you hold a lot of them, maybe you think, well, I might complement that with like a different type of investment. So maybe it's like another Australian shares ETF, but one that does something slightly different. So you're not all in one basket, so to speak. So that's something that we're thinking about. I'm also keen to maybe add some gold into our portfolio, just in a little bit of a way, which is something you probably haven't heard me say before.
No, I was going to say that's a bit of a different tune from you.
Yeah, maybe next year. So we'll see. Because I think even though gold has gone up this year, this is why it's kind of caught me off guard, is you typically should be willing to hold more gold when interest rates are lower, right? Because when interest rates are lower, you're not getting as good of a return from bonds, which pays income to you. And it's like, imagine a term deposit. If interest rates were really low, like 1% again, there's not much difference between that and holding gold. If you think about it, like even though gold doesn't pay an income, hopefully over time it goes up. But realistically, there's not much of a difference. But if you could get a 5% interest rate from a term deposit, why would you hold gold? And that's kind of the basic idea. Obviously, that it's not always that way, but you kind of get the idea. So for me personally, that's something that we're considering. And I know a few ETF providers are looking at bringing more gold type things to the market.
So something to watch in the new year.
Yeah. So obviously we'll keep doing these things. We'll keep doing these updates. I think this might be our last update here on the Australian Finance Podcast. So one of the things to keep in mind is that you can tune in every month on our YouTube channel as Mitchell and I go over all the numbers, all the ETFs, all the different holdings step by step.
Yep. So, well, that's all on YouTube. There's so much content now with all of the different podcasts and your walkthroughs and your weekly live shows back. I don't know if we've mentioned that recently on the Finance Podcast.
Yeah, it's back. It's been fun. You know, we've done a lot of different conversations over there.
We talked to Anna last week about investing for
Anna
kids,
Christina,
which I know is relevant to many listeners.
Yeah, investing for kids. We've done more kids and family type content on the Australian Finance Podcast, and that's because we're hopefully, trying to think, well, maybe we can help people at that stage of their life, whether they're expecting parents, whether they're new parents, or whether you're parents or grandparents, like established in your role in the family, and how you can help kids or families and things more broadly. So, we shall see. So, we've had some great conversations on the live show. It's every Thursday at midday. I think the most popular, like in terms of engagement and feedback we got this year, was Nightmare on Collins Street. It's a new format that I'm running where people write in and they share their kind of like worst stories with us, like things that have happened or things that maybe have gone wrong in their financial lives. There's scams, frauds, or even just things they got swept up in, like really bad investments. We spoke about a $3 million crypto scam that was happening in real time. That was last month. And there's been a lot, like, failed brokerages and different things over the years, banking collapses. So things like that, even though they're kind of gloomy, they're kind of fun to talk about and we can learn something from them.
We all love watching a bit of financial crime and fraud on Netflix, don't we?
Yeah, I mean, we don't want to add to the kind of stigma around finance that it's all gambling and risky and all that sort of stuff, but I think there's something to be learned from that. And then the final update from me, Kate, is just on our Rask Invest service, which is the name of our live show, by the way, Rask Invest Live. But our investment service, we're seeing more and more and more people booking for calls, like free calls with our team. We're seeing what we call, quote unquote, net flows. For those of you that aren't in our industry, what that basically means is the amount of money that people are putting into the platform and investing with us is growing faster. So we're seeing that snowball get bigger and bigger and bigger. And the amount of money that we're managing on behalf of our families and things like that in the Rask Invest community is growing really fast. And that's amazing. And it's a real endorsement, and I'm humbled. And so is the team. So the average investment we expect this month per account to hit $75,000. So I don't say that to like scare people off, because obviously there's some bigger accounts and there's some smaller accounts and those types of things. But that's quite interesting. Like when you think about the average portfolio size, 75,000, I expect that will probably trickle higher over time. Not because our investing is doing well and all that. Hopefully that happens anyway. But what I mean by that is, like, I think that more people will treat it not necessarily like a simple brokerage account, but more of like a wealth solution. And so, so we're seeing that increase now, and we've got a good sample size to make that assessment, and things are going well. So, if we could wrap up this episode, Kate, I would just say, number one, don't forget that when things are scary in the stock market, in the economy, the stock market often finds a way to keep going up. And that's because in the stock market, you find the place and the people that are doing really innovative things and solving the world's problems. A lot of the negative news that you hear is just people trying to sell you clicks, And you just got to look through that and actually focus on the data. And the data is extremely positive. We don't know what the next year holds. I highly, highly doubt that we will get 30% returns from the IVV ETF over the next 12 months like we did in the past 12 months. But that doesn't really matter because over 10 years or 20 years is why you invest. And as you said at the very top of the show, more automation, more tools, more ETFs, more transparency. These are all pro-investing activities, and the government is supportive with their tax policies and wants us all to become wealthier so we can provide for ourselves. And I think the sooner you board that train, the sooner you board the train of optimism, the better you and your family will be. And I think in a decade from now, like a bold prediction, anyone who listens to this podcast in a decade from now will be wealthier and probably significantly more wealthy because you put in the time to learn and listen and grow and invest. So that's my kind of pro-optimism spiel for the end of today's show. Kate, I'm going to check back in. I'm going to set a Siri reminder. We might not have Siri in 10 years, but I'm going to set a Siri reminder on this controversial listed investment company comment you made, the great Kate Campbell. So
we probably should collect some data today to like the number of LICs and the total funds under management in LICs to compare it in 10 years' time.
Okay, I will write that data down. I'll put it in a little calendar reminder for us, and then it will send us a reminder in 10 years.
I will have totally forgot this in 10 years. You'll just creep out of the woodwork and go,
I'll just knock on your door.
Do you want to find out?
You'll be cooking a stew or something, and you'll hear this knock at the door, and it'll be me. I'll be like, hey, Kate, guess what? It's 10 years, and LICs are dead. So, no, it's been heaps of fun to record this with you, Kate. So, as always, thanks for joining me.
Thanks for listening, everyone.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.